Assalamu alaikum. Good evening and welcome to the second webinar in our series on dispute management in the built environment during periods of uncertainty. My name is Yasmin Nashawati and I lead international development for the RICS Dispute Resolution Service. Having previously lived and worked in the Middle East for almost 20 years, and throughout that time we've seen the region face disruption, change and uncertainty with remarkable resilience, pragmatism and a strong focus on delivery. While the market continues to face challenges from the ongoing situation to wider regional and global pressures, the professionalism and adaptability of those working across the built environment in the region remains a real strength. In our first session, we explored how issues can be addressed early through collaboration, negotiation, and mediation. Today's discussion builds on that by looking at how professionals can navigate uncertainty when it persists and how judgment, communication, and trust becomes even more important in difficult conditions. This session is intended to be practical and reflective, grounded in the experience of our esteemed panel. Please submit any questions via the chat function or the Q&A function, and please note the session is being recorded. With that, I'm pleased to introduce our moderator, Dr. Tariq Madani. He's the Managing Director at Global Appraisal Tech. He's an RICS Registered Valuer, an IVSC MENA SRB board member, an RICS Egypt board member, as well as being previously on the MEA regional board. He's an RICS counselor, an APC assessor, and an adjunct professor at the American University of Cairo. He has over 20 years of experience working in consulting, business development, valuation, and product management for several multinationals and consulting firms. He has a strong engineering foundation and an aptitude for business and strategy, and he is currently the managing director at one of Egypt's top asset valuation firms, leading teams in real estate, machinery, and equipment valuation, project management, and feasibility studies. As I already mentioned, he's a board member at several of entities as well as RICS, Egypt board, and with that, I'm going to hand it over to you, Tariq, to introduce the speakers and start our discussion today.
Thank you so much, Yasmin. This is an excellent introduction. Thank you so much. But I come it was a pleasure. It's my pleasure to introduce our panelists today. With all the introduction that you gave, nothing compared to the experiences that we're having today on the panelists. We are first joined by Mr. Simon Townsend. He's a fellow of RICS. He's the CEO of Avizon Young MENA, Middle East and North Africa. Simon has been based in the UAE for more than 26 years and has extensive experience in valuation, advisory, and transactions across MENA and Turkey, including over $2 billion of real estate transactions globally. I had the pleasure of having him as my assessor, so I do have an amazing experience with Simon. We're also joined by Noura Yassin, MRICS. She's a senior real estate executive with over 25 years of experience advising boards and executive committees across the MENA region on strategy, growth, capital allocation, portfolio strategy, partnerships, and major investment decisions. Noura is also active within the RICS through Middle East and Africa World Regional Board, and she brings a unique perspective today from a client perspective as she works for Aldar. Finally, we have Mr. Benjamin Cullum, MRICS, Head of the Valuation and Underwriting Middle East and Senior Director at Newmark. Ben has over 20 years of experience across valuation, development advisory, asset management, and strategic consultancy, working with governments, sovereign funds, developer and family offices and banks. Together, they bring a strong mix of strategic investment and valuation expertise, and I look forward to hearing their insights today. I'm sure this introduction doesn't make you justice, guys. You are my role models in this industry, and I always look forward to learning more from you. And today we'll be discussing some of the dispute resolution. This is day 2 of the dispute resolution webinar, and we have a few questions that I would like to ask. So I guess the way we will organize this webinar today is in 5 blocks of questions. So just to keep things in order, the first block is going to be talking about, for the audience, we're going to be talking about market context and professional judgment. Block number 2 is going to be based on assumptions, special assumptions, and uncertainty. Block number 3 is going to be evidence, constraints, and methodological flexibility. Block number 4 is managing disputes and protecting the valuer. And block number 5 is going to be on client use, interpretation, and market lag. We'll try to keep it under 10 minutes each for each block. And again, the context here is dispute resolution. For those of you who have attended last week's session, it was more geared towards construction and the construction and the QS industry. Today, we're bringing a completely different perspective from the valuation and the professional advisory perspective. Ready to go?
Ready to go?
Yeah.
All right. So let's start with the core tension. Okay, valuing in markets where reality is moving faster than evidence. So question number one, I guess I will address this to Nora. How do you reflect volatility at the valuation date without drifting into forward-looking speculation?
First of all, thank you,
Are
Tariq,
you a
for the
speculator?
introduction. Hello, everyone, and thank you for having me here. Regarding your first question, this is probably the most important discipline in valuations today. The Red Book is very clear about this. We're valuing at a specific point in time based on evidence that is observable at that date. Where it becomes challenging is when the market feels like it's shifting faster than the data. So you might be hearing from brokers that demand is softening, seeing deals being renegotiated or noticing longer marketing period. But those signals haven't yet translated into actual closed transactions. In such situation, we have to resist the temptation to move ahead of the market. We don't adjust values purely on sentiment. Instead, we reflect those dynamics in the narrative, clearly explaining why while the pricing hasn't moved yet, but they are clearly indicators of that change. And this is where assumptions become critical and the narrative in the valuation report becomes extremely critical. Even if transaction prices haven't shifted, the market often starts adjusting through softer levers like, for example, absorption rates, extended payment plans, increased incentives, and waivers. So rather than forcing a movement in the headline value, we carefully assess whether those assumptions still reflect the current market behavior. An example would be if sales are slowing, is the absorption period still realistic? If developers are offering more flexible payment terms, how does this impact your effective pricing? So we can use also sensitivity analysis to illustrate how the values may move because of those assumptions, but the core valuation remain anchored in evidence. So I think the key is balance, acknowledging change without speculating, because once we move into prediction, we step out our role as valuers. So we don't become valuers, we become predictors to the market.
Thank you for that, Nora. So I like this, accommodating change without speculating into the future, because this is valuation is a discipline that's based in science and the scientific approach based on evidence and with a balance between reflecting the past and making proper forecasting into the future. This follows up very nicely to the next question, and I guess, Simon, you can pick up on this. So where there's a gap between recent peak prices and current sentiment, how do you anchor your judgment then?
Thank you, and good evening, everybody. I mean, I think the important thing to say there is we talk about the difference between sentiment and what's perhaps happening in the market from a pricing point of view. Usually, when the market is going down. But what I would say is, if I take the UA just as an example, we've seen exponential growth over the last however many quarters, however many months. And, there's been a change, definitely an imbalance between sentiment and peak pricing there, with peak pricing changing on a hourly, weekly, daily, basis. So I think, the key, and Nora mentioned it very eloquently, and I think the key really is we have to have sight of the evidence. Now, evidence, and again, we're all in markets that 20 years ago, evidence was quite difficult to get in the region. And then, people were going further and further away from assumptions that were grounded in fact to evidence that's available real time today from, regulators, lands departments, private developers, etc. So for me, we have to look at the real pricing, not the broker pricing. And forgive me, any brokers that are listening, but, there's an awful lot of noise. An awful lot of noise. And I think, when we talk about markets climbing 30%, 40%, 50% quarter on quarter, has it really? The underlying market price hasn't driven by that price. Yes, there's some outlying transactions that have pushed up prices or pushed down prices, depending on, how the markets are looking. But the real evidence, once you scrap away the noise, the real evidence is where, one needs to be grounded. And I think that, to me, brings about discussions around how you analyze and how you assess and how you validate evidence, because, you know, again, there's a lot of noise, there's a lot of things happening, a lot of transactions being reported at all sorts of prices. But again, you know, taking on board comments Nora made about payment plans, absorption rates, you know, just look at the other terms other than the value that the price was paid for it, because the other terms can impact whether it was a soft deal or a heavy deal, you know, depending on what the market was doing. So the answer is, you know, there is usually a gap between what the market's saying and the price. You know, there needs to be that gap to allow for negotiation, to allow for an open market, a free market. But it's really down to the judgment and the rigid assessment that the valuer does of the data that's available. And it's, you know, everybody knows the valuations and the analysis of data. We've all got different eyes. We'll all look at it from a slightly different lens, you know, but it should never really be that far apart that your valuation can differ significantly. So to me, you know, the way to anchor your judgment, as it were, as you suggested, is really the robustness of your analysis of the data and the information that's presented to you. And we're in a time in the world where, you know, there is data, and trust the facts, don't trust the noise, is the way I look at it.
Thank you for that, Simon. So anchor your judgment in data and robust analysis. That's amazing. What happens though, let me ask that next question, maybe a follow-up question to Ben. If the market is lagging in terms of data and evidence, how are the valuers then also lagging, and how do you deal with that?
Yeah, look, I mean, well, first of all, hi to everyone, and thanks for the kind introduction you gave earlier. Nora and Simon have both spoken quite eloquently on that point. From the lens of the valuer, I mean, the data is clearly the proof for us. We have to look at sentiment in times where the market is I wouldn't say the market is lagging. The market's the market. Ultimately it can't lag itself. It's the proof, that data coming through. The market can stall, I suppose, where there's no transaction activity, but I don't feel we're in that market at the moment. Certainly not in the sort of GCC region, which is probably most affected, within our region here. That sort of lack of evidence, lack of proof for us to hang our hat on can, of course, lead to that sort of delayed reaction, if I call it that, delayed reaction to market shifts where the data doesn't show us. But just reiterating what Nora and Simon have said, the phrase that I was always taught was that valuation is a mirror to the market. We can't be ahead of it. We can't make the market. We can only reflect what we know is going on. Moving into that sort of crystal ball gazing exercise of looking to the future and taking up sort of too much weight of the sentiment of what's going on. As Simon says, you have to listen sort of through the noise that is there within that market to avoid the accusation of making the market. I think it's important as well just to understand and remember the sort of principle here that sort of never forget that evaluation is not a fact. It is a professional opinion. So it comes down to the experience, the expertise of those in the market. As Simon mentioned earlier, 20 years ago, particularly within the region, data was very difficult to get hold of in a transparent way. So it's almost looking to historic ways of due diligence, of trying to enhance that the whole valuation engagement to get to that professional opinion of value. Does that make sense with there? I don't want to say that valuers lag the market, that you want me to do it, but I think the data clearly does, and we can only reflect that data.
Valuation is a mirror of the market. What a saying, what a clod. You have to listen through the noise and avoid the accusation of making the market. Thank you for that. So then that would then sometimes come up with differences of opinion, and that could potentially cause disputes. So in framing the next block of questions, we're going to be talking about assumptions, special assumptions, and uncertainty. And the framing of this question is in the context of that most disputes don't come from the number, they come from what sits behind it. So I guess let me follow up on what you just said, Ben. So what's the practical distinction between an assumption and a special assumption in today's market?
Okay, well, I'd frame it that today's market, there's no real change in the general distinction between an assumption and a special assumption. I think Nora mentioned it earlier. In times of uncertainty, there is perhaps a tendency to sort of promote particular special assumptions within the valuation sort of sphere. But I mean, if we rewind slightly, I mean, and apologies to the valuers listening in on the call, but just to rewind to go, what is an assumption? I mean, an assumption is there within our guidance, within the Red Book, is made where it's reasonable to accept that something is true. That's generally used, or the net effect of that is to reduce time, reduce costs in preparing a valuation report. An example for that might be assuming that no contamination exists on a standard residential commercial plot of land. Where you don't have an environmental survey to actually point you towards the fact that there is nothing. We've tested and there's nothing there. That would be a reasonable assumption to make. On the flip side, when you're talking about special assumptions, it's the divergence away from fact. So it's taking into consideration or assuming facts that differ from those that actually exist. So I mean, I've probably gone down a rabbit hole with my contamination example, but to bring that into a special assumption might be something along the lines of, if the plot of land wasn't a standard commercial residential plot but had been previously used for a chemical plant, there would be certain purposes of valuation where it would be reasonable, and reasonable is an important word, to make that special assumption that there was no contamination. You bring that into sort of today's uncertain environment, and I think there's a temptation both from client side and also from the valuer's side to try and make their lives easier, to descend into sort of too much what-ifery, building too many scenarios that are, when I come back to that reasonable word, that are unreasonable or unrealistic, to try and make their lives easier, whether it's from the client side or the valuer's side. It must be a special assumption must be relevant, realistic, and valid for the purposes of the valuation. So you come to the current situation where clients are starting to ask for certain iterations pre-war and post-war value. Now, pre-war, relatively straightforward. We can do that by valuation date. Quite straightforward to build that in. Post-war, we're going back to that crystal ball gazing. It's something that we really can't do. We're no longer that, I'll come back to it, that mirror to the market for it. So framing the uncertainty and framing the special assumptions critically through communication with the client, and always remembering that realistic, reasonable element to a special assumption, hugely important within the current uncertainty of the markets in which we operate.
Thank you for that. So special assumption is a divergence away from the facts, but framing the uncertainty and framing the special assumptions, we always have to remember the reasonability of it. So thank you for that, Ben. Following with that question with Simon, then when does this uncertainty become material enough to explicitly disclose?
I mean, I think we have to look at almost what uncertainty is. So, it has a number of different connotations to a number of different people. I mean, for me, it's an unknown unknown. And I think we have to differ that from risk. Now, obviously, risk can be increased in certain markets, certain things happening, which bring increased risk. But you can kind of reasonably see what the increase in that risk is going to do to your market. That, to me, is not an uncertainty. It's really when, the factors, the things that are happening in the market make it almost impossible to predict, and to judge what the level of that risk would be. Now, I have an issue with, to some degree, the material uncertainty clauses and provisions around that, because I think, as a market, as a collective, as members and practitioners within a regulated environment, almost we should have a single voice on this. And what is frustrating is, if I have a number of roles where I sit client side as well as the advisory side, and with my client side role on, obviously a material uncertainty clause within a valuation does have an impact in terms of how the readers read your report, how the lenders would read your report, how shareholders would read your report, whatever the issue would be. And so, what we need is an industry that has a single voice. I shouldn't have three different valuers, two of them saying, let's say two international firms where globally their risk managers, their risk advisors have said the market is in a position wherein you should be stating material uncertainty. And then I have a perhaps different valuation firm that says, no, it's not a risk. There's no evidence to, there's no transactions to show that the market's not behaving in a way that is uncertain. Therefore, we're not going to put that in. So for me, client side, I now potentially could have a valuation that excludes any material uncertainty clauses, and business as usual. So I think the pressure, like we did during COVID, post-COVID or during COVID, as an industry, we effectively all aligned at the same sort of time. The various larger real estate advisory firms sort of all got together, as it were, and decided that the markets globally were in a position that was uncertain. And therefore, it would be prudent through consultation with the RICS and others to include the material uncertainty clause. At the moment, it seems to be a bit of a lottery. And if you're looking at a portfolio of values that, have UAE, KSA, the rest of the GCC, but also include Europe in the portfolio, the US in the portfolio, where do you draw the line? Is the material uncertainty across the portfolio, or is it just on the assets that are, potentially impacted? And so, people, for me, the uncertainty becomes, or the risk becomes uncertain when it really is impossible to see what the market's going to do. There really are too many unknowns. And I think that's not me as Simon deciding today I'm going to get my valuers to put a material uncertainty clause in. It is as a collective, as an organization, as a RICS, we need to be collaborative. And we need as a region to say, we believe that the market has reached a point where it is materially uncertain for these reasons. And then we collectively agree. The terms of the clause may differ firm to firm, people to people, but actually the context and the intention is the same. So I don't think it's one person can decide.
So uncertainty is an unknown, and it's a distinction from risk. And that's a good proposal. What we need is an industry that has a single voice to sort of protect. So from a client perspective then, Nora, do you think that we're doing enough in terms of sensitivity analysis and ranges, or are we still over-relying on point estimates? And, you can free to talk about FPGA 10 at this point.
I think historically, we probably relied too heavily on a single point estimates, particularly in stable markets where that approach worked reasonably well. But in today's environment, that level of precision can actually be misleading. Markets are more volatile now, liquidity is uneven, and small changes in assumptions like yields, discount rates can have a significant impact on valuation and as well on the market value. So presenting just one number without context doesn't always give the full picture. And that's where sensitivity analysis become really valuable and extremely important. They allow us to show how the valuation responds to changes in key inputs and give the client, to be honest, a better understanding of risk. That said, it's important to strike the right balance, because again, the valuation still needs a clear central conclusion. And then we as clients, we expect that. However, sensitivities should support the valuation, not to replace them or create any confusion. And if I want to go back to the Red Book, from a Red Book perspective, this aligns very well, I think, on the emphasis on transparency. It's not about being less certain. It's more about being open about the level of uncertainty that already exists in the market. So to answer your question, I do think the profession is moving in the right direction, but there's probably still more that can be done, and to move away from over-reliance on a single point estimates, especially in uncertain conditions.
Thank you, Nora. So relying on single point estimate is a issue of the past, or it's related to certain times. But when the levels of uncertainty are high, the key is transparency and being open about that level of uncertainty. Thank you for that. So evidence. Let's talk about the reality. Sometimes the data simply isn't there. So Simon, when comparable evidence is thin, how far can valuers flex methodology while remain compliant?
I think flex is the key word, not change. And I think, one of the frustrations for me with my APC and my assessment hat on is when you're speaking to candidates perhaps in difficult markets or other places who almost create different methodologies because they can't find a comparable, or they decide, well, you know what, we'll just do the best of three. We'll do all three and we'll divide it by an average and everybody's happy. So to me, I think, there is always a piece of evidence. Right? There is always something. It might not be an apple for an apple. It might not be, identical or easy to manipulate, but there will always be something that you can rely on. So again, the key to the valuer is, understanding what that piece of evidence, how it relates to the subject property and how far you can go before you're becoming unreasonable. And your assumption, as Ben mentioned, eloquently earlier, how far before your assumption has to become a special assumption. So to me, I think, it's looking sensibly at the data. Again, there will always be something you can find. But the concern I have is that people can't find something that's an exact replica, so they just change the methodology and think, instead of valuing a hotel based on the revenue that the hotel will come in, I can't find any comparables for a 5-star hotel in this location, so let me just do a cost valuation. And the other thing that is often concerning is that clients will potentially influence, and of course no valuers will ever be influenced by the client because they're independent, etc. But there are clients who will influence a certain approach or a certain set of comparables or information to achieve a certain outcome. And again, we have hindsight of what's happening with the hotel markets at the moment. They're not in the strongest position from a revenue point of view. Many are going to be facing P&L challenges from and how we value those at year end is going to be quite interesting to see from a revenue point of view. But just because the number goes down from last year, it doesn't mean we change it from an income approach to a cost approach. So again, flexing methodology, it's, the guidelines are there. The RICS puts very clear guidelines around when you flex methodology and when you deviate from it. So, knowing how much leeway you have and how you can use that is key. But most important out of all of that is making sure that where you do flex, you always state what you've done within the valuation report. So how you've taken that comparable, why you've taken that comparable, and how you've manipulated that comparable. The more open you are with your disclosures, the less ambiguous your valuation is and the less disputes that are going to arise. And you said it yourself at the very beginning, it's not necessarily the number, but the science behind it or the content behind it. If you make up random things and flex random things and everything else, you're leading towards a dispute for sure. So to me, it's, sensible, informed flex, but don't change it.
Sensible, informed flex. Amazing. Thank you for that, Simon.
Actually, if anybody, I'm going to put a trademark on that if it's going to earn me money.
that is a few nice quotations there. Thank you for that. So following up on that, so you mentioned hotels and the fact that it was going to be one of those issues that are going to be facing in UAE, and particularly not just UAE, frankly, in the entire MENA region. So Ben, maybe I can ask you the question as a practitioner as well. Is the increased reliance on DCF in that case, since there's going to be definitely a drop down in the performance of hotels or the income approach in general, a necessity in this particular case, or is it going to be a risk, especially when things rebound? I mean, keep that in mind.
Yeah, of course, and I think, you know, just to I guess summarize what Simon was saying there. You know, number one, that's the art of valuation, is making sure that you are able to find the right comparable and, you know, make whatever adjustments you need to for it to work within the asset and the valuation that you're undertaking. You know, particularly when that sort of comparable information is very limited. You know, and I guess, you know, the other side, again, slightly summarising what Simon was saying. Look, go right back to basics. If the methodology was sound, is sound, it will continue to be sound. So you don't need to change that. What you can do is start to look at sort of cross-referencing if appropriate, and quite often it's not appropriate. This particular type of property, you know, really does need to be valued in this particular type of way. That's, you know, ultimately largely how we've been taught. You can build, you know, bring in more sort of data-driven markets when the data is there. You can bring in sort of various comparable approaches to be able to cross-reference and check. But, you know, ultimately, you take the hotels as an example, and it won't come as a surprise to anybody to know that hotel revenues have been dramatically reduced over the last couple of months. How does that then affect the valuation if you were valuing it today? Well, there is a short-term issue, and that needs to be built into your DCF, into your cash flow, and you know, projected forward in a normal profits method valuation. But we can't just be slaves to the calculations. You know, come back to that art of valuation side as well. You know, again, going right back to the days of university and being taught. You know, ultimately, at the end, you've run your calculations, you've got a magic figure. Go away, make yourself a cup of tea, come back and have a look at it. Does that stack up? Is it reasonable or realistic to expect that, you know, the short-term issues that the hotels are facing now will have a 20, 25, 30, 45% shift in value? You know, those sorts of equations start to look wrong, and then you have to relook at your data, relook at the due diligence, and relook at particularly the deferment rates and so on that you're using within your calculations. So again, it's nuanced. Effectively, all we're saying within these uncertain markets is that it becomes a bit more difficult to value, and you need to use all the tools in your toolbox to be able to come to a sensible conclusion. And once again, not the fact, but back to the opinion of value that you are instructed to provide. So it's experience, it's communication with the client, it's understanding. Those are the key ingredients. But frankly, they're the key ingredients 3 months ago. You know, nothing really has changed there. It's just how we approach it and what due diligence we need to undertake, you know, in going forward.
So we can't be slaves to the calculation. Our reasonableness and realisticness of the assumptions on the short term have to be weighed against the long term and large impact on the value and the context of the event, the economic event that we have. So thank you for that, Ben. Appreciate that comment. I'm paraphrasing here. So Nora, then, at what point does this flexibility then become subjectivity?
That's a great question. The line between flexibility and subjectivity can become quite thin, especially when evidence is limited. But back to what Simon is saying, the Red Book allows flexibility in methodology, which is important because markets don't always behave in a way that fits neatly into one approach. But that flexibility has to be grounded in rationale. For me as a client, the distinction comes down to transparency and consistency. If you can clearly explain why a particular approach has been used, how it reflects the asset and the market condition, and apply the logic consistently, then you're still within the realm of professional judgment. It becomes subjectivity when the decisions are made without clear evidence-based rationale, or when similar assets are treated differently without justification. As Simon said, moving from an income approach to cost approach for the same asset for the same purpose. As a client, I need to understand why. Another key factor is documentation. And if I can review your valuation, numbers, reports, and follow your reasoning step by step, then it's defensible. If I can, then you're likely moving into subjective territory. So flexibility is necessary and it's key, but it has to be controlled, justified, transparent, and documented. And otherwise, it risks undermining the credibility of the valuation and the valuer itself.
Thank you. So flexibility has to be grounded in evidence. It has to be grounded in science, again, not in speculations. And we're not magicians. We are, in the end, scientists. So thank you for that, Nora. Managing disputes then. All right, now we're in the disputes territory. There will be consequences to doing a wrong valuation or giving a subjective, not subjective, a flexible opinion. So when things go wrong, Ben, how does strict adherence to the Red Book actually protect the valuer in disputes?
Okay, I mean, again, a good question. I would also include in there, it's not just protect the valuer, but protect the client as well. We're not just talking about effectively negligent valuations, but also valuations that could end in dispute between external parties as well. I guess the first thing to say, look, the Red Book is not. It's not a user manual. It's not a how to value guide. That how to value comes from academic training, through experience, and so on. What the Red Book is effectively a guide to the process of valuation. For the four of us on this call, we're all RICS members, or Simon's a fellow, but this is mandatory for us. It's strict compliance to the Red Book, and it represents best practice. What within the Red Book there are sections. So there are elements of it that are mandatory, with very limited scope to move and work outside of that. And even when those exceptions are made, ultimately, sort of the best practice and adopting the standards is recommended by the RICS. There are then elements within the Red Book that are advisory, but again, they embody best practice, and really you should follow them unless it's impossible to do so. So, with that sort of framework in mind, the strict adherence to it forms a first line of defence for a valuer, to defend that valuation. And that's really important. Ultimately, if you haven't complied with the Red Book, you're on a very sticky wicket. It's going to be very difficult for you to defend your actions, even if calculation-wise it looks okay. But pure adherence to the Red Book, although that's sort of procedural compliance, it doesn't guarantee technical compliance. So again, we fall back to that. Make sure you act and within your limitations, that your experience is appropriate for the assets that you're valuing. You've taken the right guidance. You've undertaken peer reviews. All of those elements also come into protecting the valuer and protecting the client. So it's really important to understand that nuance, that pure compliance with the Red Book doesn't mean that your valuation is correct. It can still have problems, but you've got to get the compliance right, because that's the first thing to do.
Awesome quote there. So strict adherence to the form of the Red Book doesn't guarantee technical compliance, and you can still manipulate the outcome by, even if you follow procedurally, the Red Book. So you're still liable for your opinion of value. So how does then the role of governance and in these processes, second reviews committees, play in that defensibility? Can you perhaps comment on this, Simon?
Yeah, I mean, I think we're all human beings, and the human beings can make mistakes as well as other things. And I think it's hugely important, particularly for a lot of the international firms, advisory firms, etc. They have very strict corporate requirements in order for their valuers to comply with their global professional indemnity insurance policies. So again, valuations over a certain value may well need a second or a third review, usually a third review from somebody out with the geography. If you're valuing something, let's say for an IPO, where you're giving unlimited liability to the whole world and the value you're reporting is $1 billion, that's quite a lot of risk to take on as a valuer sitting in Dubai. So you would potentially get a US, a UK, or whoever you are within your organization, whichever organization you are, to do a peer review of that, where you have to justify the processes, the assumptions, the inputs to someone that has no knowledge and no prejudice of the assets that you're doing. I think one of the challenges when you have these peer reviews, a second set of eyes, whatever you have, is if it's the guy sitting next to you, then he's not necessarily looking at it with clean eyes. He's following the same process because you've worked on it together. So it's important, I think, to always have them sense checked, if nothing more, than just the approach you've taken. Forget, let's assume that the inputs are, I can't influence the inputs. If you tell me this is the rent in this submarket, then fine, this is the rent in this submarket. You can prove it if I ask you. But what I will stress test, what I will really drill down into is, how have you applied that and where have you applied it? And sometimes if you're doing a large portfolio and thousands of perhaps tenants or sub-developments or small, etc., it's quite easy to put the wrong thing in the wrong place. It's quite easy to, put a terminal value in but still collect rent thereafter. It happens. We're human, and sometimes the system beeps and shows you a little red flag, and people get a little bit immune to actually checking in real life. They wait for the little red flag in Argus or Estate Master or whatever system people will use. But it's hugely important, not just for the valuer, not just for the client, but also really for us as a profession. Because if we're continually being seen as making mistakes because we haven't gone through the robust governance, the checking and everything else, then the trust in valuers is gone. And what's the point of having them if the trust is gone? People will just use automated valuation models. They don't need a human. So for me, I think it protects the valuer. With my corporate hat on, as I sit, signing on behalf of companies and everything else, it protects me and my corporate. Because if I'm New York Stock Exchange listed and I make an error on a valuation and someone sues me for X $1 million, $1 billion, whatever it is, I have to disclose that to the stock exchange. Doesn't go very well. So again, governance reviews, second reviews, hugely important. And what I would say is, though, by someone who actually can review it, not from your friend who sits in the desk next to you. Because otherwise, you're going to get the same answer. He's just going to agree with you. If he's your junior, sometimes he's never going to challenge you because, he's a wee bit scared to challenge you. So who you get to do your second review and who you get to, be on that committee is as important as the committee itself.
So second reviews hugely reduce risk. The obviously having second eye, independent eye, uncommon eye looking at your valuation definitely reduces that and protects you and the disputes against you and the client. So thank you for that, Simon. So making it practical then, Nora, I guess this is a question to you from, again, a client's perspective. What is the most common failure point that leads to disputes from your experience?
In my experience, the disputes, they rarely come down to the number itself. They usually come down to a lack of clarity around how the number was reached. And I think the most common failure point is around assumptions. Either they weren't clearly defined or different parties had different interpretations of them. For example, something as simple as, let's say, incentives, lease assumptions, or timing can create a significant difference in value if they're not properly aligned or not properly mentioned in the report. Another common issue which Ben and Simon touched on is inconsistency, either over time or across assets. If a client sees values moving in a way that it doesn't seem logical or consistent with previous reports, that can quickly lead to challenges. Another one is communication. Sometimes the evaluation is technically sound, no issues with it, but the report doesn't really clearly explain the rationale or the limitation or the level of uncertainty, which again, that all creates room for misunderstanding. So if I have to summarize, the biggest risks are not technical, it's not in the number, but it's all around transparency, consistency, and communication. And then the good news that all of these are in our control by clearly documenting assumptions, explaining the methodology, the approach, being upfront about uncertainty, we can significantly reduce that likelihood of dispute.
Amazing quotation, communication, and consistency and reliance on speculative assumptions could really be the core of most of the disputes. Thank you for that, Nora. I guess the last block, and before we start taking Q&As, let's focus down on the client use, interpretation, and market lag. So if we, there's an uncomfortable question to ask for the profession, right? So to what extent are we responsible for how the clients interpret and use our valuations? What do you think, Ben?
Well, look, I'm incredibly tempted to say to no extent. There is nuance, with it. I think as an end point, I think that should be our target. That we've done everything, we've been communicated clearly, all the rest of it, so that we're able to say, you've misinterpreted this, you've used it inappropriately, we're not responsible. But how do you get there? What are we responsible for? We're clearly very responsible in the engagement. We're responsible for making sure that the terms of engagement are clear, that they're explicit, that they're agreed. We're responsible for making sure that the extent of the use of the report and so on is also clear. The communication throughout the instruction obviously needs to be clear and coherent. The written word, the actual report itself needs to have that clarity. That this is what the report is to be used for, and the extent of its reliability or its reliance, and so on. What conclusions? I mean, Nora mentioned it earlier in her last response. Often the disputes come from communication issues or misinterpreting between the parties what assumptions are, and the meaning of those assumptions and so on. So that clarity is vital. And I think if you go sort of one step further and you go, look, if all of those things are obviously are important and act to avoid misinterpretation. And ultimately, being responsible for them, it's kind of what we're paid for, in the instruction. But if you've done all those things, if you've ticked every box that you can possibly tick, and you've been abundantly clear, and the client then willfully misinterprets your report and puts it to a use that is wildly inappropriate and not part of the agreed transaction, we're somewhat powerless to prevent that. But you've got to be able to tick all those boxes and show that. That then becomes a bit like what we're talking about with adherence to the Red Book. It then becomes your first line of defence. It's an avenue to defend yourself if there is then a dispute. But your responsibility is in the entire engagement. If you get that right, then it's very difficult for somebody to misinterpret your conclusions in your report, or should be very difficult for them to do so.
So thank you for this. The last 5 minutes of this webinar, please, for those who would like to ask questions and put them in the meeting chat while we take a couple of more comments from Nora and Simon. So final push here. are valuers sometimes too slow to move ahead of the market? What do you think, Nora?
I think it's a fair challenge, and the honest answer is yes, sometimes we are, but again, that's intentional. Valuers, as we said, are not meant to lead the market. We are meant to reflect it. So there is naturally going to be some lag because we rely on evidence, and evidence take time to emerge. The risk is when that lag becomes too large. If sentiment has clearly shifted, but valuation remain anchored to historic data, then we're not fully reflecting reality. That's where judgment comes in. Even if we don't move values immediately, we should be signaling those shifts again through assumptions, commentary, and sensitivities. So I would say caution is necessary, but it shouldn't turn into inertia. And then the role of the valuers is to interpret the market, not to predict, and not to use that sentiment or subjectivity in it, and not to report past transaction, but it has to contextualize with the current market condition. And the balance, to be honest, it's not easy, but it's getting in what defines good valuation practice, especially in uncertain markets.
So caution is necessary, but should not be turned into inertia. I like this quote. Thank you. And judgment is definitely necessary. Final thought leadership moment, Simon. Does caution protect us?
Always, Simon.
Maybe you can unmute your mic and help us answer this question. Or does it sometimes create risk? What do you think?
I think both caution and bravado create risk. And what I mean there, people are pessimistic. It brings with it a inherent risk in the valuation. Taking on board everything that Nora and Ben both said, if you're making assumptions because you're nervous, or you're sort of second guessing, well, the market's going to have to go down, so let me be cautious because I don't want the client to shout at me, or I don't want to get sued, or whatever it might be, then clearly that presents a risk. But as does bravado. Where people think, well, you know what, the last valuation was at this price point, I can push that up a little bit, it's all good, and pushes the valuation up. That creates more risk, in my opinion. And I think one of the challenges I have with valuations when I sit with my client hat on, clearly not when I sit with my valuer hat on, but when I sit with my client hat on, one of the challenges I have is that valuers are always looking at the report they wrote 3 months ago, 6 months ago, or a year ago. So, the view is, well, last year I valued it for X. This year, even if it's half X, I can't say that because the market's gone up. So I have to stick to last year's valuation. And the valuers manipulate to protect themselves, last year's report or the previous report. And on the inverse, it's a little healthy competition is always good. But when people have a new valuer and they say to the valuer, company XYZ valued this for X, then the last thing you want is a valuer that goes off to try and prove that the other company had got it wrong, rather than actually the value had changed, or the value was what it was. So for me, caution and bravado, yes, prevent risk, but so does arrogance of valuers and everything else. So I think there should always be a risk. If the answer was easy, then why do you need valuers? If the answer was, if you didn't need somebody to subjectively give their view, then don't speak to us. Just take a number and take it off the internet, whatever one needs to do. So the role of the valuer has to be to manage that risk, but sensibly. It's about the number, not the ego of the value, or the ego of the answer that it spits out. So for me, it's always good to be cautious. Cautious but sensible, and use the data and use the methodology and use all of the checks and balances that we've talked about. Disputes will always arise. You can't always get it right. I've sat across the table from maybe people that are on the call, and certainly people that sit on the panel where we've been other sides of a desk, where I've been an advisor, they've been the client, or, we've been different valuers on different firms. We're going to have a difference of opinion. But if we both can sit there, eloquently explain the assumptions that we made, the approach that we took, why we did this and why we did that, then it comes down to human judgment. And I think if you're professional, well-trained and in line with the market, your professional judgment is not going to differ 50% to mine, or 50% to Nora's or Ben's or anybody's. We're all in the market. We're following the process. Yeah, we're not going to come up with exactly the same number. And if we do, I'd be surprised and I'd accuse us of colluding. But it's just how you manage that risk, how you manage that caution to ensure that you give the client the right response and you protect the integrity of the RICS and the the valuation profession as a whole.
Thank you, Simon, for that. So even if there's a lack of evidence, I remember this quote from the RICS, you're still positioned as a trained professional and experienced professional to make a sound opinion of value, most than the layman. So I thank you for that. So a bit of the risk has to be taken, responsible risk. And with that, we're about to conclude our session today. So thank you, Nora, Simon, and Ben. I think there's been a very rich and practical discussion. A few key themes clearly came out through today. First, evaluation remains a professional opinion, not a fact, but that opinion must be anchored in evidence, analysis, and sound judgment. As we heard, the value's role is to reflect the market, not to create it, while also listening carefully through the noise. And second, in volatile markets, the challenge is not simply the lack of data, but how we validate, qualify, interpret that evidence. And markets may move faster than the available transaction, and this places greater responsibility on the valuer to explain the reasoning, not just present the conclusion. And the third is assumptions, and special assumptions are often where disputes begin. Thank you, Nora, for this. You said it's mostly assumptions, special assumptions, and the key message was that the assumptions must be clearly framed, realistic, reasonable, and transparent, particularly when uncertainty is material. And first, the methodological flexibility is acceptable. So you can be flexible, Simon, but you cannot be, but it's only okay when it's sensible, informed, consistent, and properly documented. And flexibility should never become a tool to reverse engineering an outcome, right? And finally, the Red Book compliance, Ben, you said that second review, well, that compliance doesn't mean that you are technically competent. Definitely manipulations happen. And Simon said that second reviews and strong reporting are not just administrative safeguards, they are part of the valuer's first line of defense. And procedural compliance alone is not enough. The technical judgment must also stand up to scrutiny. That was Ben's quote. Thank you for that. And perhaps the central takeaway is this, in uncertain markets, caution is necessary, but caution should not become inertia. Thank you for that, Nora. And the profession must remain evidence-led, transparent, and brave enough to exercise judgment while clearly explaining the basis of that judgment. Thank you, everyone. Thank you again for our panelists and our insights. And thank you, everyone who joined us today. I'm looking forward to the next webinar.
Thank you very much. Thank you. Thanks.
Bye-bye.
And thank you, Tarek, for your moderation.
I learned a lot today. See you next time, guys.
Thank you. Bye-bye.
Bye.